Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. You know, I've always found it weird that, to some degree, economic analysts consider debt a good thing. Like, if you read an article where consumer debt is going up, they'll almost always say, oh, this is a great sign. People are confident, they're borrowing, and that's good for this economy. And that's because we have an economy that is primarily driven by spending money. We have a consumer-driven economy. So I guess to some degree, it makes sense. But, you know, my mom drove the point home over and over again when I was in my teens. Don't get into debt. Don't get yourself in over your head. Use your credit cards responsibly, right? And of course, as a young man, I did not heed my mother's advice. And sure enough, I got myself into a pretty difficult financial situation with credit cards in my early 20s. Now, I understand that debt isn't all bad, okay? I get that. I'm not like totally anti-debt. It can be an effective tool in navigating our financial lives. And I also understand that running a corporation or a government isn't the same as my personal finances, right? It is fair when people say, you know, well, you can't compare the federal government with a person and a credit card. Those are different things. Yes, they are different things to some degree. I'm saying all of that to say, yes, there is a place for debt. But the reality is, as I've already said, the U.S. economy is built on borrowing and spending, right? It's a consumer economy. That's not a strong foundation for an economy. You have to produce before you consume. It's kind of an economic axiom, right? It's true in our own personal lives. I have to go produce something before I can consume it. I have to go grow some food before I can consume it. Or I have to do some kind of work where I will get paid money, where I produce something so that I can buy the things that I need to consume. We don't do that here in America. We import stuff from other countries, and then we borrow money to pay for it. And let's be honest, this model is catching up with us and not in a good way. Everybody is buried in debt right now. Governments, corporations, families, all leveraged to the hilt. And, you know, I say this often, but the problem with an economy that's built on credit is eventually you hit the credit limit. And I think that this country is getting close. I think the debt problem, the debt bubble, as I sometimes like to refer to it, I think it's one of the biggest problems facing the U.S. economy that doesn't get the attention that I think that it needs to. Now, you know, when we hit these milestones, you know, we hit a $37 trillion national debt, or we have a debt ceiling fight, or maybe a spending bill, then the debt will come into focus and people will, you know, lament it. Usually the party that's out of power, right? It's easy to say, well, we don't want to spend this money. We want to cut spending when they're not in power. The people in power are always spending more and more money. It's just the way it works. But, you know, you hit those credit limits. And this is exactly why everybody right now is so desperate for interest rate cuts, even though there are plenty of signs that inflation is alive and well. And I covered that at length in the show last week, so I'm not going to go into the whole inflation numbers again. But just to reiterate, we are in right now an inflationary period when you look at the money supply. The money supply is growing. That is, by definition, inflation. Rising prices are one of the symptoms that we get from this monetary inflation. And we are in, and have been for over a year, an inflationary period. And the fact of the matter is, when the Federal Reserve cuts interest rates, as it seems like they're going to do in September, they're going to be loosening monetary policy more. That means more inflation, right? The pusher is back with a new supply of that easy money drug. So what I want to talk about today is debt. And I want to give you an overview of exactly where we are and the possible ramifications of all of this debt. And, you know, this is really significant if you're an investor. Because, as I said, I think debt is the It's the elephant in the room when it comes to the U.S. economy. And when that debt bubble pops, and again, I think we're getting close, it's going to be just one more factor driving gold and silver higher. That's because the central bank is going to have to respond with even more easy money, right? That's what the central bank does. That's what the federal bank or the Federal Reserve does. When we have an economic crisis, then the Fed steps in and it delivers the stimulus. That stimulus is that easy money drug. And quite frankly, that's kind of what got us here to begin with, right? But they're going to bring it. I'm talking about inflation in order to keep the economy stumbling along. So let's start with the national debt. And I didn't talk about this milestone very much when the news broke, but the national debt quietly pushed over $37 trillion earlier this month. Now, what's that even mean, right? It's gotten to the point that these numbers almost seem meaningless. So I'm going to tell you some things here to kind of put the national debt into perspective. First off, it's growing really, really fast, right? It took a little bit longer to hit this particular milestone. It only took 188 days for the debt to grow from 35 to 36 trillion. It took a whole 265 days to reach 37 trillion. But you will notice that we are basically adding $1 trillion to the debt in less than a year, which is pretty staggering when you think about it. And don't be fooled. The growth of the debt has not slowed down, okay? Even though it took longer, there were some mitigating factors in there. The federal government ran up against the debt ceiling on January 1st of this year. So as a result, the federal government couldn't borrow any money until the enactment of the Big Beautiful Bill, which raised the debt ceiling by $5 trillion as of July 1st. So basically through the first half of the year, the federal government couldn't borrow. The national debt sat at the same level for that entire 6 months. When the debt ceiling, when we hit that debt ceiling, the national debt was at $36.2 trillion. So it took less than 2 months for the federal government to borrow more than $800 billion, pushing the debt to over $37 trillion. And the growth of the national debt, it's increasing at an exponential rate. So in 2020, the Congressional Budget Office projected the debt wouldn't hit $37 trillion until 2030. And this is the thing about the CBO. I think the CBO, in general, I do think that they provide kind of an unbiased look at these financial things, but they always err on the side of positive, right? They always make these assumptions when they make their projections that we're not going to have any recessions and that the economy is basically going to be a Goldilocks economy. So in 2020, 37 trillion was going to be in 2030. Where are we now? We're in 2025. So they were 5 years off. To put that growth into a little bit more context, the national debt hit 34 trillion in January 2024, and then 35 trillion in November of 2024. If you want to go back a little further, when Congress effectively eliminated the debt ceiling back on June 5th, 2023, the national debt stood at a mere 31.46 trillion. Since then, the Biden administration added 4.54 trillion to the national debt. That was just in 18 months, if you're keeping track at home. And then, of course, the Trump administration has just continued that trajectory. And, you know, the growth of the debt isn't shocking when you realize that Uncle Sam is blowing through about $500 billion every single month. If you follow the Treasury reports, you'll see that federal spending generally is somewhere between about $500 and $600 billion. So $500 billion every single month going out the door. And here's the thing. Federal spending isn't going to slow down anytime soon. You got a few people that are talking about it, but they're not doing anything, right? The Big Beautiful Bill, it did cut, I'm using air quotes around cut, it cut some spending in some areas, but it increased spending in other areas. And furthermore, those cuts weren't really actual cuts. They are a slowdown in projected spending increases. It's called baseline budgeting. So imagine that you've got spending category, and you're going to originally go from $800 billion to $1 trillion. That was the projection. And so now it's only going to go from $800 billion to $900 billion, right? They'll call that a $1 billion spending cut. They ain't cut any spending at all. They just slowed down the planned increases. So what I'm saying here is actual spending is still going to go up, even though they're calling it a cut. It's just not as fast as originally planned. So the bottom line is that even with the big, beautiful bill, spending will increase on an absolute basis. The CBO estimates that the legislation will result in an additional $4.1 trillion budget deficit over the next 10 years. So that's going to have to be covered by additional borrowing, further accelerating the growth of the national debt. So, we talk about $37 trillion. What does that even mean? So I'll try to, again, I want to put that number in perspective because trillions are almost meaningless to us, right? We don't have trillions of dollars. So in order to pay off the national debt, every U.S. citizen would have to write a check for $108,509 to pay off the debt. I don't know about you, but I ain't got $108,000 sitting in my bank account to pay my share at this point. Now, the fact of the matter is a lot of people don't pay taxes, right? So that means that the taxpayer burden is even higher. Every U.S. taxpayer would have to write a check for $323,000.53 to wipe out the debt. And this was as of a couple of weeks ago. It's probably a little bit more than that by now. And that's on top of the taxes we already pay, right? So let's look at it another way. $37 trillion. That is more than the combined annual GDP of China, Germany, India, Japan, and the United Kingdom combined. The U.S. national debt is bigger than the economies of all of those countries combined, right? Here's some other factoids just to kind of help you visualize $1 trillion. There are 1 million seconds in 11.5 days. 1 trillion seconds is about 32,000 years. If you could say one number every second, so you're counting, you say one number every second, it would take about 11.5 million days to count to 1 trillion. If you had spent $1 million every day since the birth of Christ, you still wouldn't have spent $1 trillion. And they're spending $500 billion every single month. If you line up dollar bills end to end, you could go to the moon and back around 203 times with $1 trillion. And you could wrap them around the earth about 3,893 times. If you stacked up $1 trillion bills just in a single stack, the dollar tower would rise to 67,866 miles. And think about a grain of rice. Little, right? 1 trillion grains of rice would weigh about 20,000 metric tons, right? All of these illustrations that I just gave you illustrate $1 trillion. The national debt is 37 times that number. It's huge. It's unfathomable. And we ain't paying it off, ladies and gentlemen. So I talk about the budget deficits. I talk about the national debt. I write about the budget deficit every single month. I've tracked it pretty religiously now since about, 2016 or so. But the truth is, and I know this because I see the reactions when I talk about it, most people don't care. And the reason that I think most people don't care is that we've been talking about the debt for a long time. There have been people like me for years warning, the debt's getting too big. It's unsustainable. And yet we've managed to keep sustaining it, right? We keep kicking the can down the road. And I think a lot of people think, well, nothing's happened yet. The warnings have fallen flat. Chicken Little, squawked. Everything's fine. So there's a lot of people that are under the illusion that the debt doesn't even matter. And then we have this whole really dumb monetary theory called modern monetary theory, which isn't modern and it's not a very good theory, but it's out there. And that's the idea that, we have the reserve currency, so we can just borrow money and print money and create money as much as we want to, no problem. And, they'll give you all of these accounting formulas and try to explain it. It's all BS, okay? It's all smoke and mirrors. You can't borrow your way to prosperity. And it is true that when your currency is the reserve currency, you can create and print a lot more money than you otherwise could. But at some point, people are going to say, you know what? You've abused your privilege of having your currency as the reserve currency, and you don't get to do that anymore. And that's the real problem. And we're starting to see that, right? We've talked about it on the show, de-dollarization. It's out there. But again, a lot of people think that debt doesn't matter. That's just the mentality that we have out there. Well, James Madison disagreed. He called public debt a public curse. And he said, an interrepresentative government greater than any other. Thomas Jefferson also disagreed. He called public debt the greatest of dangers to be feared. So did George Washington. He said, no pecuniary consideration is more urgent than the regular redemption and discharge of the public debt. On none can delay be more injurious or an economy of time more valuable. In fact, most of the people we think great from the founding era believed in sound money. Benjamin Franklin, Thomas Paine, they all talked about the dangers of paper money, of printing money, of creating money out of thin air. They warned us. It's one of the legacies they left us. It's part of the fabric of America's, great political economy, enshrined in the Constitution that basically we've just rejected and ignored. And that brings me to a product that I wanted to highlight, talking about America's greatness. We have at Money Metals some really cool colorized state and U.S. flag silver bars. So they're beautiful, pure silver bars, but they're colorized. So they have various state flags. You can get Florida flag. You can get a Kentucky flag, wherever you happen to be. You can maybe collect the silver bars from states that you visited. And then there's also one that's a beautiful American flag. So check those out. They make great gifts, and they're really, really beautiful pieces. I will link to those on the show notes page. But, if you are proud of your state and your country, kind of a great way to show that and hold a little more silver in your portfolio at the same time. So check those out when you get a chance. But anyway, so why does the national debt matter? Right? Why am I still talking about this, right? Why doesn't Mike just shut up about this? Well, in the first place, large government debts put a drag on economic growth. And economists have done studies on this. Now, according to the National Debt Clock, the current debt level, debt to GDP ratio is 123.3%. So we have a debt that is 123.3% of GDP. Studies have shown that a debt to GDP ratio over 90, it retards economic growth by about 30%. So it's interesting because one of the mantras that you will hear from people when they want to talk about tax cuts is they'll say, well, economic growth will pay for those tax cuts. And it's true. If you have more economic growth, then that's going to be more revenue going into the federal treasury. And that tends to shrink the deficits, shrink the debt. That's a good thing. But the fact of the matter is when you get your debt level to such an extent as we have now, well, your economic growth is actually being slowed down. So you're working against yourself, right? I think an even more concerning fact is that at some point, the world's going to decide it's no longer interested in financing the U.S. government's borrowing and spending. And I've already alluded to this, right? Because the U.S. government issues the world reserve currency, there's a lot of demand for dollars. People need dollars. The global economy runs on dollars, but that is slowly changing. We're seeing de-dollarization. We're seeing countries move to doing transactions, making deals in their own currencies. We see some countries using gold, and we are moving to what some people are calling a multipolar world, where there's not just one U.S. dollar reserve currency, but a lot of currencies are functioning in the global economy. That's bad for the dollar, because we need the world to need dollars. As the Bipartisan Policy Center pointed out, the growing national debt and the mounting fiscal irresponsibility are actually undermining the dollar. Quote, confidence in U.S. creditworthiness may be undermined by a rapidly deteriorating fiscal situation and increasing concern with federal debt set to grow substantially in the coming years. And again, this appears to be happening, right? Demand for U.S. Treasuries is sagging. That means yields, interest rates are rising, meaning that it's costing more for the federal government to service the massive national debt. So what happens when demand for treasuries falls, when people stop buying U.S. debt? Then the price of bonds has to drop and the yields have to rise in order to get more people into the market to buy those bonds. It's supply and demand. It's pretty simple, really, okay? So when demand for U.S. debt drops, interest rates are going to go up. And that's what's been happening. Interest on the national debt cost $91.9 billion just in July. That brought the total interest expense for this fiscal year to $1.01 trillion. That's up 6% over the same period last year. We've already paid more than $1 trillion just on interest on the national debt in this fiscal year. There's still 2 months left in the fiscal year. So far in fiscal 2025, the federal government has spent more on interest on the debt than it has on national defense or Medicare. There's only one spending category that is higher than the interest on the national debt, and that is Social Security. So everybody's hoping that the Fed will step in with interest rate cuts, and that's going to give a little bit of relief to the federal government. But the fact of the matter is, it's quite possible that the Fed's not going to even be able to lower federal borrowing costs, even with deeper interest rate cuts. Ultimately, the federal government is going to need the Fed to step in and put its big fat thumb on the bond market, and that would mean a return to quantitative easing. So in quantitative easing operations, the central bank actually buys treasuries on the open market. It steps out there, says, we're going to buy some of these bonds. This increased artificial demand drives bond prices higher, demand higher, right? And it puts downward pressure on yields. So this would be an ideal scenario for the U.S. government, right? It needs all the help it can get to facilitate its borrowing and spending addiction. So, I think from Uncle Sam's perspective, more quantitative easing would be great. It would lower borrowing costs. It would allow the federal government to borrow more for less, right? But the fact of the matter is the Federal Reserve runs quantitative easing operations with money created out of thin air. So this new money gets injected into the monetary system and ultimately into the economy. This is by definition inflation, right? So this is why I'm talking about this, because there is a correlation, a link between the national debt and inflation. When you have high levels of debt, you're going to end up with high levels of inflation. Because remember, every dollar that the government spends, it has to get from you, right? It's not making money of its own, unless it's printing it, right? So if it's not taxing you directly, it's taxing you indirectly with the inflation tax. That's just the nature of the beast, right? So people seem unconcerned, as I've already mentioned, about this growing debt because people have been warning about it for decades and this promised crisis hasn't occurred. But the bottom line is just because the debt hasn't caused a crisis doesn't mean it won't, right? You've heard this saying, and I think it's very true. Things happen slowly and then all at once. And, it's not a Trump problem. It's not a Biden problem. It's not whoever you want to blame. Every president since Calvin Coolidge has left the U.S. with a bigger national debt than when he took office. Every single one of them. Some have done better than others, but every one of them has grown the national debt since Calvin Coolidge. So, yeah, we have a big national debt problem. And again, it is linked to inflation. And that's why it matters to you, my dear listener, right? Because you are a person, ostensibly, if you're listening to the show, you probably believe in sound money. You probably are trying to protect your wealth from the perniciousness of inflation. You're interested in gold and silver. Gold and silver is the only immunization that you've got against this situation. It's the only way to protect yourself. You can't vote this away. You can't vote away the spending because no matter who you vote for, you get spenders. We're seeing that now. But it's not just the U.S. government, right? We talk about debt. Everybody's in debt. I mentioned this at the top of the show. Corporations are levered to the hilt as well, and we're starting to see the strain in the economy. Corporate bankruptcies hit a 14-year high in 2024, and that pace has continued through the first 7 months of this year. So this should throw cold water on those who imagine that the U.S. economy is booming. And again, it underscores the catch-22 facing the Federal Reserve as it wrestles with interest rate policies in order to keep battling what I would argue is still sticky inflation. So in July, corporate bankruptcies hit the highest monthly total, and that was 71, since July 2020. Now, what was going on in 2020? Well, as you'll recall, the government had shut down the economy for the pandemic. So we're seeing corporate bankruptcies at the level we were seeing in the early stages of the pandemic. And by the way, that number was up from 66 bankruptcy filings in June. So it seems to be accelerating. Through the first 7 months of 2025, 446 companies have filed for bankruptcy. That was the most for any 7-month period since 2010. And that was in the tail end of the Great Recession. So this is, again, one of the reasons that the markets are so desperate for interest rate cuts, right? The government's desperate for interest rate cuts because it needs lower interest rates to service its debts, and corporations want lower interest rates, so they're not having to pay more for all of the debt that they've piled up over the many, many years. So it's not altogether clear that the Fed can relieve the corporate strain any more than it can relieve the situation with the federal government, right? The central bank can push the short end of the yield curve down, right? Those real short, 6-month bonds, 1-year bonds. It can definitely have an impact on those. The longer end, the 10 years, the 30 years, that's a different story. As pointed out by BCA research bond strategist Ryan Swift, he wrote, yields at the front end of the Treasury curve would almost certainly come down in any reasonable scenario where the Fed is cutting rates. But the very long end for the 10-year or the 30-year is more in doubt. If yields don't come down, then there is no economic benefit to borrowers from the rate cuts. But rate cuts could ignite animal spirits and send risks higher in the near term. So, the fact of the matter is, 10-year Treasury yields actually rose when the Fed slashed rates by 1% at the end of 2023. And the Treasury market has continued to show strain ever since, with bond prices falling and yields continuing to rise. So, you're probably going to see an increasing number of companies folding under this debt pressure. And then we have consumer debt. So, over the last several months, we've seen a decline in consumer credit. And this suggests that Americans may have reached their credit card limits. And we're starting to see even further evidence of that debt stress as more consumers with high credit scores are starting to fall behind on their credit card payments. So the pace of new consumer borrowing has slowed to a crawl, and revolving credit, which is primarily made up of credit card balances, that actually contracted in both May and June. So over the last year or two, we've seen credit card balances, this revolving credit, we've seen it grow. And then all of a sudden, it kind of just started to slow down, and now it's basically starting to contract. So we won't get July's data until early September, but it'll be interesting because we had pretty strong retail sales. So maybe we'll see a return to the spending. I don't know. But if we go back over the last several months, we're seeing a slowdown in the use of credit cards. But even with the contraction, right, we've seen some people obviously paying off their credit cards. Americans are still buried under $1.3 trillion in revolving debt. And of course, you have this double whammy of rising debt and interest rates that exacerbates the debt problem. The average annual percentage rate currently is still at 20.13%. We still have some companies that are charging rates as high as 28%. And the average right now is only down slightly from the record high of 20.79% that was set well over a year ago now. And we're seeing growing evidence that Americans are struggling under the burden of those debt payments. Subprime credit card borrowers are struggling the most. Makes sense, right? According to the credit scoring company Vantage Score, the number of subprime borrower accounts over 90 days delinquent is up 109% year on year. Consumers with the highest credit scores are also starting to fall behind those. Those are the people with good credit. Those are the people that typically can keep up with their credit card bills. According to Vantage Score, there was a 47% year-on-year increase in late payments by people in the prime segment. And an analyst there said, even though in absolute terms the increase is modest, it shows that even consumers considered the most credit healthy are beginning to see some stress with regard to repayments. Reuters noted that there's also been an uptick in auto loan and mortgage late-stage delinquencies. A Vantage Score economist said, quote, defaults on secured loans, such as mortgages, typically happen only when the pressure on finances is too much for the consumer to manage. So we're seeing this consumer stress out there because of all of this debt. So I'm painting a pretty bleak picture, and this is why I call it a debt bubble. The government is tapped out. Corporations are tapped out. Individual consumers are tapped out. No wonder everybody wants interest rate cuts, right? We are buried in debt. But as I've said over and over again, the Fed is stuck between a rock and a hard place, right? Yes, rate cuts are justified given the debt. I totally understand why the markets want them. But the fact of the matter is, holding rates steady or even raising interest rates could also be justified because of inflation, right? We talked about it last week. We're still seeing inflation rates over 3% officially, if you believe those numbers, right? So we're nowhere near the 2% target. Haven't been near the 2% target in 3 years? And yet we've got Jerome Powell saying, it's time to cut. Well, yeah, it is, because your debt-riddled economy, your debt bubble economy cannot survive in even a moderately higher interest rate environment, right? So what are the Fed people going to do? They can't do both. You can't cut rates and raise rates at the same time. It's not a thing. They got to pick. They got to pick their poison. They've either got to pick keeping rates a little bit higher and risk plunging the economy into a recession, popping those debt bubbles, or they can go ahead and ease monetary policy, get a little stimulus in there, but they're just feeding into more inflation. This is a dilemma that is caused when you have low economic growth and high inflation. The tools the Fed typically use to direct the economy can only address one side of that equation. They can't address inflation and economic malaise at the same time. And by the way, there is a word for this kind of economic environment. It's called stagflation. And, I'm hearing that word bandied about more and more frequently in the mainstream of late, which doesn't really bode well. I think we are entering into a stagflationary period, quite frankly, where we're going to see lower growth. And we're also going to see sustained rates of inflation. But how do we get here? Well, you can blame the same people who are telling you they're going to fix it. It's the Fed. It's the monetary policy. Obviously, it's a combination of the Federal Reserve and the government, to be fair. But the Fed is running the monetary policy. The government's out there just spending money hand over fist and borrowing and borrowing and borrowing. So it's creating this problem as well, right? But ultimately, it's the Federal Reserve that created or helped incentivize this debt bubble. We had more than a decade of artificially low interest rates after the 2008 financial crisis, right? They took interest rates to zero. They stayed at zero for nearly 10 years. And then they kind of sort of started to try to normalize them. They got to I don't think they got to 2% the first time. And then the economy got shaky in the fall of 2018, we had the big stock market crash, and the Fed went back to quantitative easing, and they started cutting interest rates even at that point. And then we had the pandemic, and that gave them the excuse to go all in. We had another round of massive quantitative easing, another massive injection of money into the economy, interest rates at zero again. So really, when you get down to it, we did not have a normal interest rate environment. They were artificially low all the way from 2008 until they started trying to fight price inflation back in I guess it was 2022. So more than a decade of artificially low interest rates, it incentivized the borrowing spree. Yes, the central planners wanted this debt bubble because borrowing and spending stimulates the economy. That's what they were trying to do. Well, they did it. But the problem with debt is eventually you got to pay the bill. And of course, this also causes inflation. And the Fed people don't want you to notice that. And you did. So that's why they raised rates. And here we are today. So I mentioned, the fact of the matter is you can't vote this away, right? We can sit here and be angry about it, and I can go through the numbers, and we can point fingers at politicians and central bankers and the political class, and we can be angry, but that's not doing any of us any good. There is not a political solution for this at this point, I don't think. I don't think you're going to get a bunch of politicians who are going to have the fortitude to really deal with the problems that we have. So they're going to keep trying to keep this limping along. And the Fed's going to keep trying to, walk the tightrope between inflation and an economic collapse. And eventually we're going to get one or the other or both. So what I'm getting at here is you have to be prepared. You can't fix this. Complaining about it's not helping. But what you can do is you can shield yourself from the impact of it, right? We know that we're going to continue to see the devaluation of our money. That's what this situation is telling you. We're going to continue to see inflation. We're going to continue to see low economic growth. And your money is going to keep losing purchasing power. You can protect yourself and shield yourself by having real money, by having gold and silver. That's really the bottom line. You have to have sound money. We need sound money. And you can get sound money. All you have to do is talk to a money metals, precious metals expert. Call 800-800-1865. You can talk to a precious metals specialist over at Money Metals. They can help you figure out how gold and silver can fit into your investment portfolio, how it can help you protect your wealth. They can answer your questions. They can show you different products. Talk to them today. And if you don't want to talk on the phone, you don't have to. You can go to moneymetals.com and you can just chat with a precious metal specialist right there online. And if you know what you want, you want to get some of those really cool state flag silver bars, you can do that. You can go right to the website, buy them. We'll have them delivered to you and you'll have them right there in your hands. So do it today because this situation isn't getting any better, right? It's only going to get worse because at some point, the debt bubble is going to pop. At some point, they're going to start quantitative easing again, and there's going to be more inflation. You can be prepared for it, so do it today. So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information on everything that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, please sign up, get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also be able to listen to our Market Wrap podcast that airs every single Friday. On that show, you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. As always, I appreciate so much that you listen to the show. If you like what's going on here, please do me a favor. Leave a good review. Hit those like buttons. Share the episode. That helps grow the show. It really helps us out. Doesn't cost you a thing, but I will say thank you and be very appreciative. And again, thank you so much for listening to the show. I know there's plenty of stuff that you can listen to, and I thank you for choosing a little bit of time with me. So with that, we'll talk to you again next week.